Okay, you want to own a solar farm. Here's the pitch. Buy or lease some land. Cover it with solar panels. Sell the electricity to the power grid for 20 or 25 years. Sit back and collect a check every month while doing something good for the planet at the same time. It sounds like the perfect business. Clean, simple, and steady. And honestly, a lot of that pitch is true. Solar farms really can make steady money for a long time. But steady doesn't mean cheap, and it doesn't mean risk-free. You still need millions of dollars up front. You're locked into one electricity price for decades, and your income depends completely on how much sun actually shows up. Let's go through the real numbers. First, how much does it cost to build one? As of 2026, a utility-scale solar farm costs somewhere between $900,000 and $1.3 million per megawatt to build, including the panels, the wiring, the land prep, and the connection to the power grid. So a 10-megawatt solar farm, a mid-sized project, costs somewhere around $10 million to $13 million to build. A 100-megawatt solar farm, which is a serious, large commercial project, runs somewhere between $90 million and $130 million. That land isn't small either. Solar farms need about 5 to 8 acres of land for every megawatt of power. So a 100-megawatt solar farm needs somewhere between 500 and 800 acres. That's roughly the size of 500 football fields. Most solar companies don't buy the land outright. They lease it from farmers and landowners. Land lease rates in 2026 usually run $250 to $1,000 per acre per year, with some high-demand areas paying over $1,000 an acre. On a 600-acre solar farm, that's somewhere between $150,000 and $600,000 a year just for the land, for the entire 20 to 25-year life of the project. And just like the other businesses we've covered, most of the real cost isn't the land. It's getting connected to the power grid. Utility interconnection studies, permits, and grid upgrade costs are on top of the base construction price and can add tens to hundreds of thousands of dollars per megawatt, depending on how far you are from existing power lines. Here's something that surprises people. From the day you pick a site to the day the solar farm actually turns on and sells its first watt of power, the whole process usually takes 3 to 6 years. And most of that time isn't spent building. It's spent waiting for permits, environmental studies, and a spot in line to connect to the grid. Construction itself might only take 6 to 12 months. The waiting is what actually eats up the years. Okay, the solar farm is built and turned on. Now, how does it actually make money? Almost all utility-scale solar farms sell their electricity through something called a power purchase agreement, or PPA. This is a long-term contract, usually 20 to 25 years, where you agree, upfront, to sell every unit of electricity you produce at a fixed price. As of 2026, utility-scale solar PPA prices in the U.S. run somewhere around $25 to $45 per megawatt hour, depending on the region and how much competition there is for solar power in that area. That price is much lower than what you or I pay for electricity at home, because you're selling in huge bulk, directly to a utility company or a large corporate buyer, not to individual houses. Let's run the numbers on our 100-megawatt solar farm. In a good, sunny location, a solar farm like this might produce electricity at a capacity factor of around 25 to 30%, meaning it makes that much power, on average, compared to running at full output every single hour of the year. Cloudy days, nighttime, and winter months all bring that number down from 100%. At a 27% capacity factor, a 100-megawatt solar farm produces roughly 236,000 megawatt-hours of electricity a year. At a PPA price of $30 per megawatt-hour, that's about $7 million a year in gross revenue. Now here's the part that makes solar different from almost every other business we've covered. The running costs are actually pretty low. There's no fuel to buy, no huge staff needed. Operating and maintenance costs for a solar farm typically run around 1 to 2% of the total construction cost per year. On our $115 million solar farm, that's roughly $1.2 million to $2.3 million a year for cleaning panels, replacing broken parts, mowing the land, and monitoring the system. Subtract that from your $7 million in revenue, along with your land lease payments, insurance, and property taxes, and you're left with a healthy net operating income. Often 80 to 90% of your gross revenue actually makes it to the bottom line before debt payments. That's a much higher margin than almost any other physical business, because once it's built, a solar farm mostly just sits there and works. But, and here's the catch, that huge upfront cost has to be paid off somehow. Most solar farms are financed with a mix of debt and something called tax equity, where investors provide money upfront in exchange for tax credits the project earns. If your $115 million solar farm is financed with, say, $85 million in debt at a reasonable interest rate, your annual loan payment could easily be $5 to $6 million a year. Subtract that from your operating profit, and your actual cash profit might only be $500,000 to $1 million a year on a project that took years to build and tens of millions of dollars to finance. This is the real trade-off in solar: low ongoing risk, but a very long payback period. Most solar farms don't turn a serious profit for the owner until year 8, 10, or even later, after enough of the debt is paid down. Now let's talk about the risk that keeps solar developers up at night: the fixed price problem. Remember, your PPA locks in your electricity price for 20 or 25 years. That's great when prices are low and you locked in a decent rate. But if the market price for electricity rises sharply after you signed your contract, because of inflation, fuel shortages, or high demand from data centers, for example, you don't get to charge more. You're stuck at your locked-in price while your operating costs, insurance, and property taxes all continue to rise around you every single year. And on the flip side, if you didn't lock in a PPA at all, and you're selling electricity on the open merchant market instead, your revenue can swing wildly year to year based on wholesale electricity prices, which is a much riskier way to run a 25-year investment. Let's walk through how this actually goes wrong in practice. A developer builds a 50-megawatt solar farm in 2021, financing it with a large construction loan, betting that interest rates will stay low and that a nearby utility will sign a strong, long-term PPA. But by the time the project is ready, interest rates have climbed sharply, making the loan far more expensive to refinance than originally planned. Meanwhile, the utility, facing its own financial pressure, only agrees to a lower PPA price than the developer had modeled because several other solar farms finished around the same time, creating more competition for buyers in that region. Now the developer is stuck, a higher loan payment than expected and lower revenue than expected, arriving at the exact same time. The solar farm works perfectly. The panels produce electricity exactly as designed, but the math behind the deal no longer works. This exact combination, rising interest rates, oversupply pushing PPA prices down, and construction cost overruns, has squeezed a real number of solar developers in recent years, even while solar power itself keeps getting more popular. There are also smaller, quieter costs that chip away at profit. Panels degrade slowly over time, losing maybe 0.5% of their power output every year, so a solar farm making full power in year 1 makes noticeably less by year 20. Inverters, the equipment that converts the panel's power into usable electricity, typically need to be replaced once during a 25-year project, and that's a real, planned expense most new owners forget to budget for. And severe weather, hail, high winds, can damage panels in ways that aren't always fully covered by standard insurance. Big energy companies and utility-scale developers have real advantages here too. They can negotiate cheaper panels and equipment by buying in huge bulk. They can get better financing rates because banks trust their track record. And if one project underperforms, it barely matters, because they own dozens of solar farms across different regions and weather patterns, spreading out the risk in a way a single project owner never can. Let's compare a good outcome and a bad outcome for our 100-megawatt solar farm. Good case. You locked in a solid PPA price before market conditions shifted, construction came in on budget, and the sun cooperated with your capacity factor estimates. Revenue comes in as planned. Debt gets paid down steadily, and by year 10 or so, you're earning strong, largely passive cash flow for the remaining 15 years of the contract, with very little ongoing work required. Bad case. Interest rates rose during construction, your PPA price came in lower than modeled due to oversupply in your region, and a bad hailstorm damaged part of the array in year 3, costing hundreds of thousands of dollars not fully covered by insurance. Your debt payment barely gets covered some years, and what should have been a comfortable, low-effort investment becomes a tight, stressful one for the first decade. Same solar farm, same panels, same sunshine. The entire difference comes down to financing terms, contract timing, and how conservatively the original deal was underwritten. So what actually separates the solar developers who do well from the ones who struggle? Locking in a long-term PPA before starting construction, not after, so your revenue is certain before you take on debt. Financing with fixed-rate, long-term debt, instead of anything that resets with the market. Budgeting honestly for the inverter replacement and panel degradation everyone forgets about. And building in real markets with real grid capacity. Instead of chasing the cheapest land in a place where getting connected to the grid takes 5 extra years. So, is owning a solar farm a good business? For developers who lock in solid contracts, finance conservatively, and are genuinely patient, solar farms can be one of the steadiest, most predictable income-generating assets you can own. Low ongoing costs, decades of contracted revenue, and very little that can go wrong once it's built correctly. But it's not instant money, and it's not risk-free. It takes years just to get through permitting before construction even starts. It takes millions of dollars of debt that has to be paid down. And your income is locked in for decades at whatever price you signed, for better or worse. The sunshine is free. Getting paid for it reliably, for 25 years straight, is the actual hard part. Thanks for watching. Let me know what you want me to break down next.